You've been watching SpaceX launch rockets, dominate space contracts, and basically rewrite the aerospace playbook. You're thinking this has to be the next Tesla-level opportunity, right? Here's the thing, you're not wrong about SpaceX's dominance, but what's happening with SPCX stock right now is more complicated than the headlines suggest. I'm a Nexus AI analyst, and I've spent years tracking what actually moves markets beyond the hype cycles. Right now, SPCX is sitting at a fascinating inflection point that most people are completely missing. The stock just dropped 26% in a single month, trading at $115, dangerously close to its 52-week low of $115. But here's what caught my attention: while everyone's panicking about the price drop, the underlying business fundamentals tell a completely different story. The question isn't whether SpaceX is successful, it's whether this stock price reflects reality or opportunity. Let's start with what SpaceX actually does that nobody else can replicate. They've essentially created a monopoly on cost-effective space launches through reusable rockets, something that seemed impossible just a decade ago. The Starlink satellite internet business alone could be worth hundreds of billions as global internet demand explodes. Then there's the NASA contracts, commercial launches, and the potential Mars colonization project that could dwarf every other space venture combined. Here's the kicker: at $115, this stock is trading 49% below its 52-week high of $225. If you believe in the space economy's long-term trajectory, this pullback might be exactly what patient investors have been waiting for. But that's not the full picture. Here's where things get uncomfortable for SpaceX bulls. First, the company is still private, which means SPCX stock represents a complex derivative exposure, not direct ownership. Second, Elon Musk's attention is split between SpaceX, Tesla, X, Neuralink, and whatever new venture captures his focus next. Third, the space economy is still largely speculative. We're betting on a future that may take decades to fully materialize. The recent 26% drop isn't happening in a vacuum either. Rising interest rates hurt all high-growth, capital-intensive businesses, and SpaceX burns cash faster than almost any company on Earth. What really worries me is the lack of institutional tracking. No major funds are publicly reporting SPCX positions, which suggests smart money might be staying on the sidelines for now. This is where the analysis gets really interesting. When I look at our institutional tracking data, SPCX shows 0 major 13F filings, meaning the biggest hedge funds and investment firms aren't publicly reporting positions. That's either because they're not buying, or they're finding alternative ways to get space exposure through ETFs or private markets. Compare this to other space stocks where you see clear institutional interest, and SPCX starts looking like either a retail-driven play or something institutions are approaching very carefully. The absence of smart money doesn't automatically make it a bad investment, but it does suggest we're in uncharted territory. Here's what would change my mind completely. I'm watching 3 specific catalysts that could send SPCX in either direction over the next year. First, any announcement about going public or restructuring the stock to give direct SpaceX ownership would be massive for price discovery. Second, a major Starlink revenue announcement or customer milestone could justify the space economy valuations everyone's betting on. Third, and this is the big risk, any sign that launch costs are rising or competition is catching up could crater the monopoly thesis entirely. The recent drop to near 52-week lows suggests the market is pricing in some combination of these risks. What I find most telling is that at $115, we're testing the absolute floor of institutional interest. This is where buyers typically emerge or stocks break down completely. Here's my honest assessment after digging through all the available data. SPCX at $115 represents either a generational buying opportunity or a value trap disguised as innovation. The company's technological moat is real, the addressable market is enormous, and the current price reflects maximum pessimism. But the lack of institutional validation, the complex ownership structure, and Elon's track record of overpromising on timelines create legitimate reasons for caution. If you're bullish on the space economy and can handle extreme volatility, this setup has asymmetric upside potential. If you need predictable returns or clear institutional backing, there are probably better places to park your money. The key is knowing which type of investor you actually are. Look, I can't tell you whether to buy, sell, or hold SPCX. That's your decision based on your risk tolerance and investment timeline. What I can tell you is that this analysis just scratches the surface of what's available when you dig into the full data. Head over to nexusaicalls.com to see the complete institutional tracking, sector comparisons, and real-time updates as this story develops. Remember, even the smartest analysis means nothing if you don't do your own research and understand what you're buying. The space economy is coming, the question is whether SPCX is your ticket to ride or a detour you can't afford.